Are you certain that this could be related to Trump, or is it something that's unwinding on the markets, not necessarily related to these animal spirits?
Well, I think it is related to the animal spirits. We've had, if you think back since the election of Donald Trump, stock markets have had a fantastic run. So yesterday, of course, we had a little bit of a setback. Let's put it in context. It's around 1%, just over 1%. So yes, we're down. We're still up over 5% on the year. And I think what we're seeing is now markets focusing on not the rhetoric, which has been very positive from a growth point of view, from a reflation, from a deregulation point of view, but now getting into some of the details of dealing with the Affordable Care Act, the repealing of that, the relationship that Trump will have with Congress. So I think to some extent yesterday reflected, okay, so now we've had the rhetoric. When we get into the reality, is he able to achieve all of the things that he was promising?
But what is this, a dip or actually a downwards trend unless we have more details?
Well, I think we're going to see a bit more volatility. I'm not sure if it's a dip or a downtrend. I think we're just going to see more volatility as the reality of dealing with some of the details, getting them through Congress comes to play. So for us, we're not overly bullish on stocks from these kind of levels, in part because valuations are already pretty high. It doesn't mean we aren't going to have some sectors do well and others do poorly, but overall, it's hard to be super bullish from these kind of levels. So I think you should expect to see more volatility. We're going to see it in the equity market. I think we're going to see it in the interest rate markets as the economy develops and as we see some of these debates and discussions take place.
Andrew, let's go back to a longer term chart. We showed this the other day. People love this chart. This is the total return of equities and the total return of bonds. And what I use here is a total return of the Standard & Poor's 500 is one proxy. Obviously, the white line more volatile. And the bond line is the Bloomberg Barclays Lehman total return sovereign full faith and credit aggregate U.S. index. And what I want to know, Andrew, is what is the confidence at Goldman Sachs Asset Management for bonds right now? I mean, I guess yield up, price down. How do you manage that reality?
Yeah, and we would certainly be in the camp that we think interest rates are moving higher through the course of this year and maybe even through the course of next year. So I think it's going to be a tough environment to generate meaningfully positive returns in fixed income. There are opportunities, we think, in credit markets, there are opportunities in emerging market debt, but it's going to be an environment with the Fed raising interest rates through the course of this year at least a couple more times that you're going to get pretty muted returns. So then it comes back to how do you position a fixed income portfolio? Yeah. And our views, you want to focus more on sort of absolute return type products. Of course, a good number of our clients are managing against a liability profile, so that's a slightly different dynamic. But for those who are looking for absolute returns, we think it's time to shorten duration, reduce exposure to that rising interest rate environment that you referenced.